Welcome to the Capital News. I am your host, Alex Karitis. Today is March 20th, 2019. Thank you so much for joining me on this first day of spring, and let's hope that it's a nice spring and we can get some sunshine and warm weather here in the not-too-distant future. But we have quite a bit to talk about today because Chairman of the Federal Reserve, Jay Powell, was out. He gave his press conference and his little speech there, so we're going to get into that here shortly. But first, how did the markets behave? Well, the S&P was down 8 points. The Dow was down 142, the NASDAQ was up 5 points, and the Russell 2000, the small cap index, closed down for the day 12 points. The stock markets, all of them were whipsawing pretty much all day. Just par for the course. We had a couple news events, obviously the Federal Reserve, but we also had President Trump come out in regards to the U.S.-China trade talks, and now here we have it again, ladies and gentlemen, another plot twist. The current tariffs might be staying on indefinitely because the Chinese are walking away, at least in part. They took some of the things that they were allegedly offering off the table. The markets didn't like that yesterday. The president obviously didn't like it, and now he's saying the tariffs are staying on. The question will be, does the president of the United States step up to the plate and be the tough guy that he claims that he is and puts on the additional 15% tariffs? Because if he wants to win this quote-unquote trade war, that's what he's going to have to do. He's going to have to do it. Now, I know he boxed himself in with saying he owns the stock market. He loves the stock market. It was a bubble when he was a candidate. It was a bubble under Barack Obama, which it was. But newsflash, it still is. But now he owns it. So does he want to put on an additional 15% in tariffs because he knows very well the likelihood that this market will not like it and it will go down? And is he going to have to take ownership of that? Is he willing to sacrifice his baby, the stock market, to get his other baby, the best deal known to man, accomplished? Because that's what he's going to have to do. He's going to have to put a hurting on the Chinese, and I really don't know, to be honest with you, if that's really going to even hurt the Chinese in the grand scheme of things. We're already in the midst of a global economic slowdown, and the Chinese are not as export-driven as they used to be, and they're already ramping up their stimulus efforts. So I don't know what's actually going to take place here. It's an interesting game of chess, because if you look at it from the Chinese perspective, they might be playing a long game here, and they might say President Trump, he ain't going to win in 2020. There's no way. There's no way. Especially if the Chinese can hurt us economically in one way or the other, or at least hurt the president politically in saying, yeah, we're just going to play hardball. We're going to walk away from the table. We're not going to give you this, that, and the other because we don't want to. Because one of these lunatics might actually win in a year and a half, and then we'll just manipulate them and eat their lunch like we have everybody else for the past 20 years. So the president, I don't know if he's boxed himself in or not. I think the president can maneuver. He is definitely not a dead dog here. He still has teeth. He still has claws. He can most definitely maneuver. I mean, this ain't his first rodeo either. But it just becomes very interesting because a lot of this is self-inflicted. If he didn't take ownership of the stock market to the extent that he has and does, it wouldn't be an issue for him. He could just focus on this deal and he could get it done. Now, whether it's going to be the best deal ever, well, I mean, I'm highly skeptical of that, but that's just his rhetoric. That's how the man talks. We know this. But nevertheless, it is an issue, both politically and economically, and that moved the market. So we'll see what happens. Oil, our good old buddy, is above $60 a barrel. We'll get to that in a second. Gold had a nice little move, was up $16 today, and now it's settled at $13.18 an ounce. And silver had a nice little run up and is now at $15.59 an ounce. The 10-year Treasury, and remember, this is getting more and more important as we go along here, especially with more news coming from the Federal Reserve. The 10-year Treasury now sits at 2.54%. That's down 3% in one day. In one day, a 3 percentage point move in one day. That's huge. I mean, we've been having the discussion here of this rate lingering around 2.6, 261, 262, 259. Now it's at 2.54. Okay? That says something. It says that the market is now anticipating lower interest rates and a slower economy. And we're going to get into that because those were basically the comments from the Federal Reserve today. Then just to talk about it, because we brought it up yesterday, we had the VIX up another 2.5 percentage points today and settled at 13.91. And the dollar was down across the board. So you have to remember President Trump, his speech at CPAC not too long ago, and we covered this extensively here on this podcast, that the president wants a weaker dollar. Well, he's getting it. He's getting it. I don't know if it's in thanks and in part to his, I guess, new buddy, Jay Powell at the Federal Reserve, but the dollar was down across the board. I anticipate this to be short-lived, but nevertheless, the dollar was down. It took a nice hit today, and that's why you have oil up over $60 a barrel. You also continue to have some oil inventories decreasing, so that contributed to that as well. But that's also why you had the additional run-up in the precious metals market space, gold and silver. That's also why you have a 10-year Treasury note that is at its lowest yield in a year, because people are buying in to the U.S. Treasury because they're looking for safety and they are anticipating a slowdown, not just globally, which we already know, but here in the United States. Why? Because that's what Jay Powell told us. What did the chairman of the Federal Reserve tell us? What did one of the three stooges tell us this afternoon? Well, he said the U.S. economy is strong, but they're revising down their forecasts for GDP for 2019 and for 2020. So we had 3.1% economic growth, GDP growth through 2018. Okay, the president was able to pat himself on the back. All of his economic advisors were able to pat themselves on the back. Yes, we did it. We broke through that threshold. We got the 3 percentage points we wanted, and actually we got 3.1%. So everything is just fantastic. Of course, if you listen to this podcast, you know better. But nevertheless, those are the talking points. But now, according to the Federal Reserve, they are lowering their forecast to 2.1%. So 1 full point is removed. That's huge. When you have a $19 trillion economy, a $20 trillion economy, 1% can be a big move. And it's definitely not in the president's wheelhouse of saying it's going to be 3%, 4%, 5%, whatever he wants to say. So we have a discrepancy here between what the White House is projecting and what the Federal Reserve is projecting. So maybe Donald and Jay aren't that good of buddies, even though we have a weaker dollar. So what is this setting up for? Well, we have this thing, if you're in the know in this terminology, and you watch some of the financial news, it's called a dot plot. And what this is this allows the members of the Federal Open Market Committee to basically put a dot on a piece of paper as to where they think interest rates will be in the coming months and quarters ahead. That's all it is. It's a dot plot. Then we're told by Jay Powell in his news conference, and he's basically quoting or paraphrasing Janet Yellen, one of the other three stooges, that, we post the dot plot, we talk about the dot plot, but you're really not supposed to pay attention to it. You're really supposed to listen to what I say in the minutes from the committee. That's really what you're supposed to pay attention to. Well then, it stands to reason, Jay. Why do we have the dot plot if you're not supposed to pay attention to the dot plot? Why waste everybody's time? Is it just a distraction? Because everybody throws a hissy fit on Bloomberg or CNBC or Fox Business. Well, what's the dot plot say? Well, we're not supposed to pay attention to it. So why do they do it? No idea. Must just be a distraction. But what does the dot plot say, and in addition to what the chairman said? Well, come last December, everybody was anticipating that this year, 2019, was going to see at least 2 interest rate hikes. Maybe 3, but at least 2. Then you had the 180, the policy 180, because the markets crashed. The stock market, the Wall Street, the crackheads threw their hissy fit. And so Daddy Government and Daddy Federal Reserve had to come to the rescue and say, no, here's your fix. And they did their 180 policy. Okay? They did a 180 on their policy. So now it was projected, well, there's probably going to be at least one interest rate hike in 2019. Not 2 or 3, just one. Some people thought maybe 2. Because after all, the president says this is the best economy ever. And the Federal Reserve even today says the U.S. economy is still strong, even though we're revising lower our economic forecast for 2019 and 2020. We're not going to raise interest rates because we just can't do it. And because the markets, the babies, are going to throw a hissy fit and we can't have it. We just can't stand it. So we have to prop this market up. It has to be rigged. It has to be a bubble. It has to be maintained at all costs. And if you follow this podcast, you know why it has to be maintained at all costs from their perspective. Because they don't want to be left holding the bag. They don't want to have the fingers pointing at them, that they're the ones responsible for this. So they're just going to kick the can further and further down the road, which just makes that final day of reckoning that much worse for everybody. But that's what they do. That's what they've grown accustomed to. Again, go to sleep, take a nap, the government will take care of you. That's what they say. So that's where we are. Now, what other damage has this done? You look at the yield curve, something we've been discussing here on this podcast. Pay attention to the bond market. Pay attention to these yields. Well, if you look at the 6-month yield against the 1-year Treasury, 2-year, 3-year, 5-year, 7-year, it's inverted, which means the 3-year Treasury yields a higher rate than all of those other ones. That's not good. You remember what this means? It is a leading indicator that a recession is on the horizon. Again, this doesn't mean it's a snap of the fingers, blink of the eye, flip of a switch, that we're in a recession today or tomorrow or even next month or a few months from now, but one is on the horizon. And we know this just from the natural order of things and understanding the business cycle and the credit cycle. This is what happens. We just celebrated, if you will, the 10-year anniversary of this bull market. It's really a BS market, but that's the bull run that we've had for 10 years now. And it's because of all of this money printing and all of the other manipulation that we talk about here every day, because we have to be aware, because we have to be prepared for what's coming. We just have to. There's no ifs, ands, or buts about it. If you are an investor or just somebody who lives and breathes, because even if you don't invest, you will be affected economically. And then depending on that situation, you'll be affected politically, because everything's connected. So you have to be an informed citizen, and that's why I do these shows, because I am trying to educate people to the best of my ability to be aware of what is likely to happen. Now, you could disagree with me, and that's fine. We can have an honest debate. I'm not opposed to having those types of debates. I like those debates. I am not right 100% of the time. I will never pretend to be correct 100% of the time. But I also don't just speak loosely. I put a lot of thought into what I say, because that's just how I am. That's my nature. There's enough people bloviating just about anything and everything under the sun when they don't have much knowledge of it at all. That's not me. That's not this program. So when I say something, it's because I look at the data, I think about the theory, I look at how the dots connect. What type of picture does that paint? Again, you look at the economy as a puzzle, a 1,000-piece puzzle. You put the pieces together. What is that picture? What is that puzzle of? What is it showing us? What direction? These are basic questions. And if you go through this methodically and you take your time and you remove as much emotion as you can, which is difficult. I know it's difficult to remove the emotion, but if you're as objective as you can be, you will end up on the right side of things in time. You will. So that's what I do. I want to do it day by day, look at these points by points. It's important to look at the stock market. It's important to look at the bond market. It's important to look at the price of oil, the Treasury market, all of this stuff. It's very important because these are all separate and individual pieces of the puzzle. Sometimes they move in tandem. Sometimes they move against each other. Sometimes it's a one-off. Sometimes it's forming a trend. That's why you have to stay on top of it and pay attention, because you never know if it's just a crazy day, there's low volume, or it's something serious and fundamental. Has there been a turning of the tide? Is there a fundamental shift in the attitudes and the psychology of market participants, not only in the stock markets and bond markets, but also in the real economy? And that's what we have to pay attention to. And if you have a marketplace that is connected between the real economy and the stock market, then you can make some wise moves and be in the right place at the right time. The problem that we have now and have had for quite a while, and I imagine we will continue to have this for a little while longer, is the fact that we don't have a stock market that is understanding what is really going on in the real economy. They are disjointed. Disjointed. We have these conversations all the time. Here's poor data. Doesn't matter. Bad news is good news for the stock market. The U.S.-China trade talks falling apart, or at least some walking back. Yeah, they went down a little bit. They went down a little bit, but they did not go down nearly as much as they have rallied on the supposed good news. So this market is definitely being manipulated. It's most definitely being manipulated by the Federal Reserve. We talked about the share buybacks. We talked about President Trump and his tweet back in December, and the Secretary of the Treasury meeting with the plunge protection team to keep this market up at all costs. And that's what we've witnessed for the past 3 months now. 3 months. We are at the end, almost, of the first quarter of fiscal 2019. Already, the first quarter. So, as far as the share buybacks are concerned, there's going to be a blackout for, well, probably 5 to 6 weeks, starting at the end of March, definitely through the entirety of April, and then maybe the first week or so of May. So it's going to be interesting to see where the volume is going to come from to keep this market afloat, because we know that net foreign investors are leaving the U.S. marketplace. They are. Net foreign investors are leaving the U.S. marketplace. So we have them gone. We have a blackout for a month and a half of share buybacks. Where's the money going to come from to keep this market propped up? Might be coming from the Federal Reserve now, because were they more dovish than what the markets were expecting? I think to some degree they were, because, again, with the dot plot and with some of the conversation, there might be a rate hike this year, but probably not. We anticipate, this is the chairman of the Federal Reserve, this is Jay Powell, we anticipate no further interest rate hikes in 2019, but we expect one in 2020. Now you have to look at the balance sheet. What was that discussion? Well, we're going to end that runoff probably at the end of September. So we have 6 more months of the Federal Reserve. They're going to continue to sell treasuries into the market. They're going to continue to sell mortgage-backed securities into the market, and then that's it. And whatever level they are at, whatever dollar level they are at on their balance sheet is it. That's fine. They're fine with whatever it is. Maybe $3.5 trillion. I don't know. They don't know. They did a policy 180 a few months ago. Who's to say they're wrong again, and during their next speech or a subsequent one thereafter, they change their mind again? Their credibility is completely shot. Remember, they sent the Three Stooges out, Jay Powell, Janet Yellen, Ben Bernanke, out to 60 Minutes to talk to Scott Pelley, who doesn't know his you-know-what from his elbow, to ask them the most softball of questions. But then they don't bring Alan Greenspan on, because Alan Greenspan doesn't agree with them, because the Three Stooges think everything's going to be fine, although the economy is going to slow down a little bit. But don't worry, everything's going to be fine. Trust us. We're always right. But Alan Greenspan says, no, we're going to have stagflation. We're going to have almost no growth, maybe negative growth, and there's going to be inflation. Not a good combination, believe you me. And there's a lot of you listening who lived through that time of the 1970s, and it's probably not a good time to recall economically, because it wasn't. So we might be headed for that again, but if you listen to the Three Stooges, everything's fine. Where does this leave us going forward? Very interesting question, because despite the fact that the Federal Reserve was a little bit more dovish than what was somewhat anticipated, the S&P was down 8 points. The Dow was down 142. NASDAQ was only up 5. The small caps were down 12. I mean, weren't we told that this is the heroin, this is the crack that these addicts want on Wall Street? You have a weaker dollar? Isn't this supposed to be, hooray, this is what we wanted? Or are we coming to the crossroads of one of the biggest concerns that I have, that was also on our list of the 30 market risks for 2019. Remember what that is? That's quantitative easing and lower interest rates not having any punch. It's done. It's done. Because if these tools are no longer effective, then where's the bottom in the stock market? Where are you going to get the stimulus to keep this economy, this great economy afloat, and this bull run? How are you going to continue it? Because despite the fact that the president has just put forth his 2020 budget of $4.75 trillion with trillion-dollar deficits as far as the eye can see, so much for draining the swamp, is that going to be enough to prop up this market? I don't think so. I don't think so, especially if the marketplace says, you know what? Oh, maybe bad news is bad news. You know, they've been shrugging it off for quite a while now. Now maybe bad news is bad news. Because we're told from the White House everything's grand. It's great. Never been better. Of course, we know that's not true. And now you have the Federal Reserve lowering their forecast, but they're saying everything's fine. And you have markets, including the bond market. That's why you have the Treasury yielding 2.54%, because the bond market is now anticipating lower interest rates. And they're anticipating the Federal Reserve is going to cut before they actually do a hike. This is not good, ladies and gentlemen. If you follow this podcast, you understand why. It's just not good. This is just further manipulation. This is further kicking the can down the road. And if this is some sort of read between the lines admission by the Federal Reserve that, hey, this ain't a great economy, that we have a lot of headwinds not only from around the world but also here domestically, I mean, if this stuff starts coming to fruition, which it already is, but now, is the tide going to turn? Are we going to have that fundamental shift? What's going to take place in the midst of a president who wants to own this stock market, lock, stock, and barrel? I mean, not good politically, not good economically, just bad policy all around. And then I just want to throw in this other tidbit because I know I've had this discussion too with the draining of the swamp, and maybe the swamp is alive and well with a $4.75 trillion budget with trillion-dollar deficits as far as the eye can see, with an additional $2 trillion already tacked on to the national debt. And we talk about the military and industrial complex being alive and well in full swing when you look at the stock prices of Boeing and Lockheed Martin, and you know the names for the past 3 years since this president has been the president. And then you have a acting defense secretary who is a former executive of Boeing. And now get this, some of you I'm sure were aware of this. This isn't breaking news of any sort, but just to remind you that Nikki Haley, the former ambassador to the United Nations, is now a board member at Boeing. Isn't that interesting? Oh, so much for draining the swamp. I mean, I still have hope in this president. I know he is up against a huge wall of resistance, but there are just a handful, and it's a big handful, of data points and promises that were said that have not been kept. And they're big ones. They're doozies. There's have been a lot of promises that were made and are kept and are in the process of being kept, and that's honorable, and I appreciate it. But I do not follow anybody blindly, and I'm not going to get caught up in a cult of personality, and neither should you. Be objective. Again, remove the emotion. He is up against a huge wall, no pun intended. But he's going to have to start doing a little bit more for me. For me. Again, you follow this podcast, you follow most definitely the geopolitical podcast. I say that President Trump is going to win quite handily in 2020 because of the lack of talent on the left, let's say. Let's just put it nicely for once. So there is a lot of things that are all taking place, and nothing has been checked off the list. We went through that entire list, that list of 30 things, and then the 31st thing that we added to the list was the fact that Deutsche Bank might be in trouble. Well, if you've been paying attention to some of that news, Deutsche Bank is now in more aggressive talks with Commerzbank, which is another German bank, and it's partially owned by the German government, to merge. These banks, neither of them on their own are healthy. Putting them together is not going to solve the problem. This, to me, is very much akin to J.P. Morgan purchasing Bear Stearns before all hell broke loose in 2008, 2009. That's what this looks like to me. because you have the German regulators and members of the German government saying, well, if we can merge these two banks, these two powerhouses, this will be a, quote, national champion for the German people. Wrong. Wrong. It will not be a national champion. They are riddled with so much debt. They are leveraged like you cannot believe. They are caught up in so many scandals, most recently having to deal with money laundering. There's no end in sight. You look at their share price, and particularly Deutsche Bank, it has just cratered for the past few years. It's just cratered. It's in the single digits. It's a shame, but this is where we are. And that could be a huge risk that nobody is really paying attention to. So you have to be mindful of all of those risks that we discussed and other ones that continue to come to the forefront. I don't even know which one is going to take the cake, but the fact that they all exist at the same time, it's like which stick of dynamite is going to be the one that actually gets lit. Really doesn't make a difference because you have a whole bunch of, you got a bunch of TNT. All it takes is one to light it off and boom, it's all gone. And that's where we are. That's how sensitive everything is. And most people are not aware of this, but you are. You are, because you pay attention. Not only to me, but you are. You know it. You have to feel it in your gut and trust that gut feeling that you just can't listen to all of the talking heads and all of the talking points on TV and on the radio. You got to do your own investigations. You got to dig through it. You got to put aside the personality. You got to put aside the emotions to your best effort and just look at things objectively. What does the data say? What is the puzzle telling us? We have more and more pieces falling into place every day. What does that picture tell us? I'll continue to do that. Thank you so much for joining me today, ladies and gentlemen. It has been a pleasure having you. As always, stay on top of these people. It is our job to do so. It is our obligation as citizens of this country to do so. Please stay on top of this. Please like, share, subscribe, get the word out. Leave your comments. I'd love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.